Good evening, everyone, and welcome to the session today. Um, Today, we are going to discuss about the ongoing interest rate decisions and the speculation on it. Why we are calling it a roller coaster? Because there has been a lot of anticipation by the investors and traders on how soon the interest rates are going to be cut or what is going to happen, and on those rumors and speculation a lot of times we have seen major stock indices, major commodities have reacted. And it's only fair to say that the market has been really volatile. It has moved a lot. There are a lot of fluctuations. And when I say fluctuations, that means there has been prices have been going up and down, and it has been happening at a faster rate. And that is what we call as a volatile market. Of course, we cannot take volatility out of the financial markets ever. If it's not interest rates, it's going to be elections. If it's not elections, it's going to be pandemic. If it's not pandemic, it's going to be something else, which is going to bring a lot of buyers and sellers in the market. And that's what moves the market. Today's session is all about understanding what is happening, why it is happening, and what is going to be the impact, and how you can navigate through this impact by managing your risks well. We're going to, if we get time, we're going to look into the live platform as well. And there is a chat option available to all of you, since this is a webinar, and it's going to be just me talking for an hour. So I'm sure that all of you will have a lot of questions. And as and when the question comes into your mind, just use your chat options to write it down. And if I'm in the middle of the slide, once I finish it, I'll be able to answer the questions one by one, and we'll continue to be more and more interactive this way. So if you have any questions, if you can hear me right now properly, let's just test our chat options right now. If you can hear me right, if you can see my presentation, just write yes or okay, and then I can proceed with the rest of my session. And once again, welcome to all of you. I see a lot of people here today, and let's hope that we make this session more and more interactive. And if you have any questions, even the most basic to the most advanced, just ask, and I'll definitely try to answer as much as I can. Now, once we proceed forward, please remember, whatever we are going to discuss today, whether it's going to be strategies or ideas, insights, this is for your information purpose. Anything which we are going to discuss, I would always suggest you, before executing that, do have a talk with your investment consultant or risk manager, right? None of the strategies or ideas which I'm going to tell you are risk free. None of them. Every single idea, every single insight, it does carry a risk, and that is a risk of investment. There is absolutely no way that any sort of returns can be guaranteed in financial markets. So there is always a risk. And yes, as investment consultants, we work on managing that risk and trying to diversify into different strategies, put your money into different places. So, at one point of time, if one market is down, maybe the other market is up, or the other asset class is performing well. And I think that is how we need to design a proper portfolio mix as well. So please do talk to your risk managers, and let's see this session the way it is, as a good source of information. Now, the Federal Reserve and the interest rate. So today we are going to cover two major economies. So one is US and other is Europe. And we are going to discuss that what is happening to the interest rates over there, what is the condition of the economy, impact to which, how this can bring a change in stocks, in commodities, in currencies, in indices, and what has been the reaction to different kinds of news. And you can write it down on a piece of paper if you have any good point if you hear. And anyways, after this particular session, all of you will have another chance to book a live session one-on-one with me, as and when is your convenient time. So that is also something which can be done. And the recording of this session will also be put on YouTube, so you can view it later also. Now, few important things which we have seen in last 2 to 3 days. And I will come to the recent news also. And first, to explain you the relationship between the central banks and the interest rates. Federal Reserve is another name for the central bank of US. So there is a central bank in every country. There's in India, there's in Pakistan, there's in Sri Lanka, there is in US, there's in Australia, New Zealand, UK. Everywhere the central banks exist, and they play different roles. They become lenders to the commercial banks, they regulate the commercial banks, they control the supply of money. And one of the most important thing they do is taking decision on interest rates to control inflation, right? So the central bank of US is called Federal Reserve. Why I'm telling you this? Because any of my friends over here, or any of my attendees over here, if you have not seen the news, or if you're not following the news about stocks or commodities, a lot of times on any website or in the newspaper or the news, you will see this word Fed talk about interest rates, Fed tighten up the policy, Fed cut it. Fed or Federal Reserve means Central Bank of US, right? How it is connected to the interest rates, how the inflation targeting is done, and what is the benefit out of it. So there is a concept called inflation targeting. As we all know, inflation is a part of our lives. We may not like it that much, but the point is inflation is everywhere. We are living in UAE, there's inflation, I'm sure. um, there has been a slight increase in rents here, but if you see countries outside, that increase has been even more than here. So inflation is something which is an inevitable part of our world, and we always see that how inflation affects our spending capacity. It has a huge impact on our disposable income, and that's why inflation needs to be controlled. Too much inflation, why it needs to be controlled, why we should not just try to prevent inflation from happening at all, because it's not good. Too much inflation not good, but too low inflation also not good. So central banks have given a target that there should not be increase in the inflation over a year, not more than 2%. 2% target has been given by most of the central banks in the world, and that target is followed by major central banks. And the moment inflation goes beyond that target, it worries the central banks, it worries the investors also, right? So they need to control that and bring it down to the target of 2%. Sometimes if prices drop too much, if there is no demand for the product, the prices might drop because there is no motivation for the suppliers to produce that. So we have seen excess of supply, less demand brings the prices down, and it causes deflation in the economy. Like it happened with the Japan, it happened with China, that the economies went through deflation, and that's not good either. Because if people are not spending money on consumption, that means that economy can never prosper, because more spending leads to more production, leads to more jobs, leads to more economic activity, and that basically increase the prices. But when it happens too much, when the prices start going higher too much, then it becomes difficult for the common or the average income holder, or people who are living below the poverty line, to be able to afford even the basic products. And that is the reason why inflation needs to be controlled. Central bank takes the responsibility to control the inflation using different tools. And the inflation target, as you see the circle, what you see in the circle is that how central bank, to control the rate of inflation, they have to control the supply of money. Very simple. When we talk about the interest rate, so I talked about two things. One was the Federal Reserve, which is the central bank of US. Another thing which I talked about is the interest rates. Which are these interest rates we are talking about? So here, when I will talk about interest rates in this context, I will be talking about the cost of borrowing, the rate at which commercial banks give you the loan, the rates at which central bank gives loan to the commercial banks, right? When I talk about the Fed funds rate, I'm strictly talking about the interest rate at which the central bank of US provides loan to the commercial banks, right? So this is basically the cost of borrowing. How increasing or decreasing these interest rates affect the inflation? That is the question which I'm going to answer to you. And if you don't understand it, you can again ask your questions. As I said, very simple. Loan means a lot to a lot of people. Today, if you have to buy a car, you have to buy a house. If you have to buy a house, you look for a mortgage. You have to buy a car, you look for auto loan. You need money for your business, you're looking for a business loan. You need money for your personal consumption, you're looking for a personal loan. So borrowings and credit, it has become a very important part of the financial system. Bigger companies, even smaller businesses, they like to borrow money because they want to use the debt and expand their businesses, right? Now every time you borrow money, the one thing which you should be very careful about is the amount of interest which you will pay. In a interest rate environment where interest rates are high, like if you compare uh, interest rates now as compared to probably 5 years ago, there's a big difference. 5 years ago, if you take a mortgage or if you take an auto loan, the interest rate will be much lower. But now if you do that, the interest rates are slightly high. Now what happens when interest rates are too high? What happens when the cost of borrowing, when the cost of loan is higher? The companies and the individuals overall, they borrow less money, right? They reduce their credit consumption. Why? Because they know that they have to pay a higher interest rate. So they reduce down the borrowings. When they reduce down the borrowings, their consumption goes down. When the consumption goes down, the demand for the product goes down. When the demand for the product goes down, the motivation for the supplier to produce that product goes down. And that is why the price also slowly and gradually comes down. And that is the reason we always talk about that when the prices are down, sorry, when demand is low and supply continues to in excess, the prices drop. And when that happens, we see the inflation coming down, right? This is the role and the ability to increase the cost of borrowing or decrease the cost of borrowing, that only remains with the central bank. Any country's government cannot interfere in central bank's decision, at least theoretically, right? There were days when Donald Trump became the president and he continuously tried to put pressure on the Federal Reserve to keep the interest rates low, right? So corporations and companies, they can borrow more money. So the whole idea about inflation is to control the inflation, the central bank increases the interest rates. When loans become expensive, people borrow less money. When they borrow less, they spend less. When they spend less, the demand for the product comes down and the price drops, and eventually the inflation gets under control. They cannot increase the cost too much, because eventually, if the unemployment rate is high, if there are not enough jobs being generated, then cheaper, then expensive loans are only going to hamper the economy more. So before any decision is taken towards the interest rates, the central bank must monitor the unemployment rate. They must monitor that how many jobs are being generated in the economy, what is the manufacturing index like, how is the housing market doing, and all these important economic data comes out on day basis. And that is the reason why it is really important for anybody to keep a track on what is happening to the interest rates, because it is going to create an impact on your investments, which are in bonds and stocks and commodities. And we are going to understand that how it normally does that, right? Again, guys, as I said, that if you don't understand anything, if you have any questions, please use the chat options to ask any questions. And as and when you keep asking the questions, I'll try to answer, and then we'll keep progressing with the presentation. Now, as we have always seen, in an era of where inflation is too low, central bank, they want inflation to reach to a particular target, because only then producers will be motivated to produce more. So when inflation is too low, the loans are made cheaper, so people can borrow more money, they can invest more, they can expand their businesses, they can increase their consumption, which can increase the demand of a product and eventually motivate the producers also to produce more. But then the demand goes up, the price also moves higher, and that is how the inflation slightly goes up. So it has to be under control. And that is the reason why central banks normally they tweak around the inflation, tweak around the interest rates to control the supply of money. It's basically very simple. If the supply of money reduces, the dollar becomes more stronger, right? And that is where the inflation increases. If the supply is too loose, if there is excess supply of dollars, it devalues the dollar and inflation increases. That is why it is important that there must be a balance. Why I'm spending a little more time in explaining this to you, because this is connected to what we are going to discuss further, right? If you're talking about interest rates back and forth, you should know that what are these interest rates we are talking about. When I say Fed or when I say central banks, you should understand that why are these related and what is the big fuss about it. Now, moving on to the part, when we talk about the monetary policy, there are different ways how central bank conducts the monetary policy. So there are two kinds of policies. One is monetary policy, which central banks create, and then another is fiscal policy, which the government takes decision on. Central banks cannot interfere with government. Government cannot interfere with central banks, and that is how it works. Now, in monetary policy, central banks take different use different ways basically to reduce the supply of money or to increase the supply of money, right? Now there are traditional ways of doing this, there are non-traditional ways of doing this. I will highlight two important ways how this is, or three important ways how central bank does this. And please hear this out and remember this. And if you have any doubts, do ask me. This is really important for anybody who's trying to understand the current investment market right now. When inflation is too high, as it was in 2022, central banks across the world, not just US, in Europe, in UK, across the world, they increased the cost of borrowing, the interest rate, right? Why they made loans more expensive? So that people can borrow less, they consume less. When they consume less, the prices are going to come down and inflation will drop. And that was the expectation. So if the inflation is high, one way to control the inflation is increase the cost of borrowing, make loans more expensive, right? That is one. Second is what popularly it is known as selling of the bonds or the government bonds. Central banks buys a lot of government bonds to increase the supply of money, right? When I say central bank buy government bonds, that means that they give loan to the government to spend more, right? So anybody who buys a bond, which means they are giving loan to that particular issuer. In case of government bonds, if the US government issues the bonds, which means they are seeking loan, and when central bank buys those bonds, they basically give loan to the government. Now, when they do that, that is only done to increase the supply of money. Once that is done and they see that inflation is going up, they start basically selling those bonds. Selling those bonds means they are selling bonds back to the government. So the whole idea is that these bonds are purchased to increase the supply of money, and then they are sold once the supply is enough to take some supply out, because too much money in the market creates inflation, and then to control the inflation they can sell these government bonds, right? So that is another way how the money supply can be controlled. And third, again, very important thing is mostly it can be through the reserve requirements. So basically what happens is there is a certain deposit rate which is provided to the commercial banks when they keep their money with the central bank, right? And this is a very popular way in Europe. And the deposit rate is basically the money which somebody will receive on the deposits. So if the deposit rate is high, then most of the commercial banks and even people, they're encouraged to keep money in the banks because they will get higher deposit rates. And when that happens, people spend less, they save more, and they keep the money carefully in the bank. So that is also a way to reduce the supply of the money by increasing the deposit rates, right? And if the deposit rate is less, then what will happen? Then the investors will be forced to take that money out. When I say forced, that doesn't mean that banks force them. It's just when the deposit rate is low, why would you keep money in the bank? You would rather invest it into stocks or riskier assets to achieve higher returns. And that is how the use of deposit rates is done by the central banks to control the inflation. Basically, inflation can be controlled by increasing or decreasing the supply of money. And that money supply can be increased or decreased by either printing more cash and injecting in the economy through asset purchase or bond purchase, and the interest rates. And when I say interest rates, cost of borrowing in US, in Europe, mostly using the deposit rates. So this is, again, guys, very important piece of information. This will clarify your thought that why people care about interest rates a lot, right? Now, going next, this is something which a lot of people would want to know, and this is we have built up a couple of strategies around this, and you must understand this. There is an asset class which is called bond, right? Bond has been a very traditional, very old asset class. It's not something new, but it really caught up a lot of attention after 2021, because when inflation increased, central banks, they started making loans more expensive, right? Now there are at least two traditional ways you as an investor can invest. One is by investing into companies like Amazon, Microsoft, Google, what it is called share market, stock market investment, right? In a stock market investment, when you're buying a stock, you are a business partner to that company. So today, if you have bought Amazon shares, you can buy Amazon shares, you can sell Amazon shares, but you cannot ask for an interest from Amazon. You cannot tell Amazon that I have given a loan to you and now I need interest for the loan which I have given. No. Shares means that you are a business partner in the company, right? Company makes money, the value of the share goes up, you make money. The company doesn't make money, they are not in a profitability phase, the price drops of the share and you lose money. So that is one way you invest, which is stocks, by becoming a business partner. There's another way which you can invest, and that is by buying bonds. When you buy shares, you're a business partner, but when you buy a bond from anyone, you become a creditor. Because when you're buying a bond, you are giving a loan to that particular issuer. So today, if Apple or Facebook or any government has issued bonds, that means that you, as an investor, are giving a loan when you are buying the bond. And the bond certificate specifically says that this bond certifies that Mr. Yogesh has lent us this much money, and this bond will mature in 10 years. Until the time we are using Mr. Yogesh's funds, we will pay him a fixed coupon, which is also called interest, of 4 or 5% or whatever is the interest rate, which is fixed by the central bank that time, right? So bonds is a very a traditional form of investment. It's basically called a fixed income product, right? So anybody who is closer to the retirement or who is very conservative or who do not want to speculate too much or want to preserve their capital, they mostly invest in fixed income bonds, right? There are two kinds of issuers. One is government. Government needs money time to time to invest in infrastructure, to cover their deficits, and that is why government issues these bonds. So people like you, people like me, institutions, they buy these bonds and give loan to the US government, or any government for that matter, which is issuing bonds. US government bonds are called treasuries. German government bonds are called German bonds. a basket of these bonds is called buxel, which also we are going to talk about, right? So when you buy a bond, you're basically giving a loan to the issuer of that bond. You must remember, not only government issues bonds, there are companies also which issue shares and bonds as well. So the difference between, if you buy the share of Amazon, you're a business partner, right? If the company gets bankrupt, you will be the last one to get paid. In case of the bond, you receive a fixed interest, and in the case of the bankruptcy, your money will be paid to you first because you are the creditor of the company. So that is why stocks and bonds are two very different kinds of investments with different kinds of risks and return. Now you must understand the impact of the interest rates on bond prices, because when you buy a bond, you receive an interest, right? What interest it is, what it is based on, it is based on the interest rate which is fixed by the central bank, right? Now I'm going to give you an example. You can write it down if you wish to, or verbally understand this. Let's say you buy a US government bond which is giving you 2% coupon a year, right? That means that when you're buying a US government bond, you're giving loan to US government, and in return of that, US government is giving you 2% interest. Okay. You carry that bond certificate with you, which mentions as a promise that till the time this bond matures, let's say for the next 10 years, you will receive 2% interest. Correct. Now you are very happy, you are getting a fixed income in dollars, and that's 2% a year. You are happy with that. Why you are happy with that? Because you know that eventually you are going to get your money back, and it is the issuer of the bond is US government. So the only way you are not getting your money back is if US government runs away or gets bankrupted, right? That's the biggest uh, challenge, or that's the biggest risk when you are giving loan to somebody. The person runs away, right? Or they're bankrupt. So in case of a US government bond, the chances of that happening is less. And that is why a lot of investors, they buy US government bonds, because they get a fixed income and the risk is less. Now that coupon which they receive, or the interest rate as I call it, which they receive, is based on the interest rate which is set by the central bank. Now you are carrying a bond which is giving you 2%. Imagine that inflation increase, and when inflation increased, we realized that the interest rates need to go up because people have too much money in their pockets. They're demanding more, and that's why the inflation is going up, because prices are going up. So central bank decides, instead of 2%, let's increase the rates to 4%. Now the moment interest rates goes up, now I want you to focus on the first part of the slide, the first box. The moment interest rate goes up, the bond which you are carrying right now, the price of that bond comes down, because you are getting 2% on your bond, while in the market the interest rate is 4%. So what we understand from this, that whenever the interest rates go up to control inflation, the bond prices, they come down. Similarly, when the interest rate comes down, look at the second column, when interest rates come down, the bond prices, they go up, right? Why the bond prices go up? Because if you are getting 2% on your bond and the market interest rate is 1%, then the value of your bond automatically goes up, because your bond is giving you a better return than the entire market. So that should be sold at premium. This is the inverse relationship between interest rates and bonds. Now let me ask you a question and answer this using your chat options. Currently, US government is giving 5% on government bonds, which means if you buy a US government bond, say for 10 years, year on year you will receive 5% interest, right? That is your bond, which you have. Answer this. If central bank talks about cutting the interest rates, right? They see that inflation has been under control. Now there is no need to make loans more expensive. They are talking about cutting down the interest rates. Let's say your bond is giving you 5%, and the US government and the US central bank decides to cut down the interest rate from 5 to 4%. Now, I want you to answer this. What is going to happen to the price of your bond? Is it going to go up or is it going to come down? In the market, interest rate is 4%, has been cut down to 4%, while your bond is giving you 5% interest. What is going to be the price of your bond? Is it going to go up or is it going to come down? Please try to answer this question so you will understand the concept of bond and the prices of bonds and why the investors would prefer bond investments in an interest rate environment. Try it out, guys. Once again, your bond is giving you 5% coupon, and the central bank decides to cut down the interest rates. What is going to happen to the price of your bond which you're holding? Will it go up or will it come down? Okay. I think I've started getting answers. Perfect. Try it out, guys. Try it out. Those who have not. If you have a question, ask. Because now you should be able to answer this question, right? And this is going to form a foundation of your understanding about bond investments and interest rates. And that is the most easiest way you can understand this. But again, as I said, that I'm always available for a one-on-one personal session as well. And anybody who is attending this webinar is eligible to have that session. So till then, try to answer this question, guys. Perfect. Okay. Perfect. I think most of you have answered the right thing. The price of the bond will go higher. Why? Because the bond which you are holding is giving you 5%, and while central bank cuts down the interest rate in the market, your bond will look more attractive to the investors because in the market the new bonds are providing return of 4%. And that is the reason why there's an inverse relationship between the interest rates and bonds. Currently, there's another question here that can bonds be bought same as stocks? Yes, in fact, but I must tell you that a lot of shares are available fractionally. Like if you want to put $1,000 or $2,000 on smaller quantities, as you suggested, you can buy shares. In bonds now, there are a lot of US government bonds which are available in fractional quantities, in smaller quantities. But some bonds, which like UK government bonds, they still require a minimum of $200,000 order ticket to begin with. US government bonds are available in small quantities. UK government bonds are not. But if you try to work with a bank, then banks always carry a minimum order ticket. That's why a lot of investors, they use these online platforms where the fractional quantities are available, right? And in terms of pricing also, these platforms work better than most of the banks. So yes, some of the bonds are available in fractional quantities. Some of them, they carry a minimum order ticket size, and that can range from $200,000 to $250,000 also. Right now, that being said, what will be the impact on your investments of the current interest rate roller coaster? And before I reach to here, let's understand what is going on right now. Now, this is the most important thing, right? Before we move on to the strategies and understand the impact. What is going on right now? Of lately, there were a lot of rumors in last 2 years. Central Bank of US has cut down interest rates, has increased interest rates at least 11 times, right? At least 11 times. That is where because the inflation was so high, the target of central bank was 2%, it went up to 9%. And when that happened, everybody was in the panic mode, and central bank had to do simultaneously multiple rate hikes to bring inflation down. And now it is at 3.4 or 3.5%, still not up to the central bank's target. But That is the reason why the interest rates of US went around 5 to 5.5%, right? Something around 5.5%. It was around 0.21 and 2%, and then it moved to 5.5%. Because to control the inflation, Fed aggressively increased rates in last 2 years. Now, obviously, when that happened, inflation came under control from 9%, came down to 3.5%. That's exactly what was the objective. Now, once that happened, traders and investors they started speculating that for years and years since 2008, uh, US economy has worked with a lower interest rate in a lower interest rate environment, and now it is 5%, so loans are expensive. Now, since inflation is under control, shouldn't central bank try to cut rates down, right? So that loans could become cheaper and economic activity again can take a bigger pace and people can start borrowing again at a cheaper interest rate. So a lot of analyst rumors came in. A lot of analysts they did their predictions that by June there will be rate cuts in US, and that kept putting stock market on a rally mode. Stocks kept going up. Why stocks kept going up? Because companies they love to borrow money and expand and develop and put money into their business, right? And when loans are cheaper, that reduce down their interest rate cost and increase the profit margins. But when interest rates are expensive or loans are expensive, that reduces down the profitability of the company. That is why a lot of corporates they work in cheaper interest rate environment and they work well. And that's why when interest rates are low or if a news comes that interest rates will be cut, stocks go up. That is the reason why US indices in last 3 months have rallied higher. Right, as I said, if we get time, we'll go through the chart of the major benchmarks as well and how they have performed. Now, what happened is in last few weeks, this has been observed that the inflation has again been slightly on the rise, right? And that is the reason why central banks have come up, the US central bank has come up with the statement that it's highly unlikely that the central bank will cut interest rates because economic data is coming good. The manufacturing, the job generation, economic growth is stable, right? And this is when the interest rates are already 5%. So they really don't want to take that risk that they cut the interest rate, again, inflation starts rising, and then again they have to increase the rates. So they don't want the economy to go through this again. So they are expecting the rates to be kept same, and that will be done till the time they see that economic data is coming fine, everything is positive, and once the economy recovers further, only then they will decide to cut rates. So at this point of time, central bank has clearly stated in a Fed meeting that they are in no hurry to cut down the interest rates. They still lack that confidence to cut a rate and expect that inflation will not go up. So at this point of time, that is the news which has rattled the markets completely. The stocks did not take this news really well, and the reaction was not really pleasant because the stocks, US stocks, they came down suffering their worst day of 2024. And this was today on Thursday. And when we look at the benchmark index, I think Dow Jones, for example, has been going up in last 4 or 5 weeks, and Dow Jones have also started coming down. So I think the message is very clear. Economic growth is stable. It's not rising, but it is stable. Inflation is still present, and of course, there is a higher cost of living which has been observed in many countries. So that is the reason why central bank has decided to keep the rates same for indefinite period of time before they really observe that growth is on the rise and inflation is under control. Now that has brought stock markets down. Uncertainty of what is going to happen with interest rate has also brought oil prices down, right? Dollar has become more stronger because the supply of money will still be less, which makes dollar more strong. And that is why the currencies which are compared to dollar like euro and pound, they have come down. One asset class which has also dropped is the bond, the US government bond, because an expectation of a higher interest rate means that the bond return or the bond yield will be higher. Bond yield means the basically the coupon which you receive, the interest which you receive on the bond, the total return on the bond. It will be higher if the interest rates go up, right? But if the interest rates were to cut, then the bond prices would have gone up because of the inverse relationship which is discussed. So right now, as we speak, stock markets are down. Gold prices have dropped slightly, around 1% as we talk. Oil prices have come down. Dollar has become stronger, and the currencies which are compared to the dollar have gone weaker. This is about US. You must also see the inflation as we speak. The Fed target is the red line, as we see the red dotted line. This is the Fed target, 2%. And as you can see, in 2022, look how high the inflation went, around 9%. And now it has come down around 3.5%, very close to the Fed target, but still not there. And that is the reason why central banks are very hesitant to cut down rates at all. This is from US, right? Now, let's talk about Europe a bit. Because why Europe? Because when US increased the interest rates to fight inflation, and the entire world was facing the inflation due to excess of cash which was being injected post pandemic and during the pandemic. So Europe also increased the rates, UK also increased the rates. Europe, in fact, was very late in increasing rates. But when they did, it had an adverse effect on their most top performing economy, which was Germany. So when the interest rates went up, when loans became expensive, obviously there is a contraction in the economic activities, right? You see economic activities reducing when the loans become expensive. And that impacted Germany a lot, and Germany dipped into recession. Looking at that, European Central Bank, they stopped increasing rates, and wherever the rate was, they left it there. And now they cannot increase it more. Inflation did come down a little bit, of course not up to the target, but they became scared that if Germany goes into recession further, it will impact the economy, so they stopped. Now at this point of time, US and Europe are talking about two very diverging monetary policies. While US continues to talk about not cutting the rates at the moment, Europe is very open to cut interest rates, right? That means that expectation from European bonds, the prices to go up is higher as compared to US. Because if interest rates are cut, then the existing bond prices in Europe is expected to go up. The adverse effect, right? Because when the rates cut, the bond prices go up. Reason, the bond which you are holding is giving you a higher interest. So in the market, when rates are down, the value of your bond automatically becomes higher. And that is the reason why we have put both the economies, because we are looking at different investment options in both the ideas, right? So now when you understand the part how interest rates are currently in these two major, because look at the Europe right now. You see the blue part is the European Central Bank, red is US, and blue is UK. And as you can see, Europe was the last one to start increasing rates, but is going to be the first one to start cutting rates also, while US and UK, they continue to be higher. So that is the reason why I have added Europe also in this, because there are some products which you can look and try to capitalize on this interest rate roller coaster which is happening between US and Europe, right? Now let's understand the strategies. How an investor, and this is what brings me to the last 15-20 minutes of this session, how the investors are going to discuss, or how the investors are going to be navigated through this interest rate roller coaster. Because in US, benchmarks have been falling a lot, right? In stocks have come down, gold prices are dropping, oil prices are dropping. A lot of companies which did not come out with good earnings, airline stocks fell down a lot yesterday. We saw companies like Salesforce, due to poor earnings, the stock is also down around 15 to 16%. So how do we navigate through this roller coaster? And this is apart from your normal investments which you have already done. I'm just giving you a few options. As I said in the beginning of this session, please consider all of these as information. Before implementing any strategy, do talk to your risk experts, do talk to us before you execute anything, right? Treat this just as an information for now. Now I'm going to discuss something with you. There's something called volatility index. Okay, volatility index basically measures the degree or the rate at which the US benchmark index S&P 500, how much activity or up and down is expected in S&P 500 in the future, right? And volatility index measures that. It has been observed there has been some sort of inverse relationship between the price of the volatility index and the movement of S&P 500. During the pandemic, when volatility index was at its peak, that is where we saw, when volatility index was at the bottom, we saw S&P 500 started crashing due to pandemic. We saw volatility index rising, and when things were normal, we saw S&P 500 rising again and then volatility index coming down. Now, in a high interest rate environment where there is a little expectation of central banks to cut rates at all, if a lot of you investors are already buy on the stock market in US, you can also try to take a buy exposure in volatility index. Again, as I said, this is not a recommendation or suggestion or any kind of trade. This is just for information purposes, that anybody who has a portfolio where they are buy on stocks, I'm going to share something with you. A lot of times the index are not available on these platforms. You can do it through an exchange traded product. And let me share the screen with you right now, so you can exactly see what I'm talking about. So here it is, talking about volatility as an asset, hedging against market downturns. And we are talking about, so I'm going to give you a small description of uh, what this is. And as I said, please continue to ask any questions. I am getting a lot of requests over here. So when I end the session, I'll be able to answer these questions as well. Now, as you can see, it's written in the flyer that traditional investments, they suffer market swings, uncertainty, right? Sometimes downward trending markets. And if you're buy on these portfolios, it can really impact your portfolio as well. And that is something which is very common, and it happens a lot of times that you are on the buying side of the stock. But what eventually happens is market starts coming down and there is nothing you can do, just buy and hold. So during such times when you're looking that the markets are at its peak and it is expected to come down, there is a way, or there is expected news which could come. There's a way that you can try to hedge or balance that risk by buying a volatility index based product, right? Volume and volatility are likely to increase under the following circumstances. When the volatility increases, black swan events, like we are talking about geopolitical crisis, war situations, natural disasters, something like pandemic, for example. And that is the time when volatility increases and the volatility index also increases. During economic downturns, when the economic data is very disappointing or central banks are talking about changes in the policies which can fear, there are fears of recession, that is also the time when a lot of investors, they seek investments in volatility based products, right? Sometimes during the earnings season also, if the lot of companies, they are disclosing financial results and they're not up to the expectations, the stock markets could take a dive and volatility index again can go up. So these are the times. Now there are different products which allow you to take exposure in volatility. One of them is the ETF, the exchange traded product, which is created by a sponsor called iPath, right? And this is something which is a financial instrument. This gives you an exposure to the volatility. Again, when I say volatility, I literally means the fluctuation of the stock market. And we have observed, as I said, that whenever the stock starts coming down, we see the VIX or the volatility index based product started going up. Now, the product which you see tracks the future contract of the volatility index. right? And volatility index is the barometer of the investor uncertainty. So this is the product which is available. This is last price was around $15.45, right? Currently, you can check how much the current price is. I think it must have gone up since the stock markets have come down since last few weeks, and that is the reason why we look at these kind of products. Again, a lot of people will not normally tell you about these things, because sometimes it becomes really complicated to explain this at what it is. But as I said, that this is an introduction to what I'm talking about. You are interested to know more that how to invest into this, please feel free to have a personal session, and we'll definitely even tell you and show you in the platform that how you can execute this trade and how you can buy and hold on to it. Now, a small scenario analysis was done here by the research team, and it was observed that between 2019 to 2024, for like 5 years, there were at least 112 occasions where it was observed that S&P showed negative returns 3 consecutive times, right? Say month on month on month, 3 consecutive negative returns for S&P 500, and that happened 112 times. Out of 1256 observations which we did in 5 years, 112 times it has been observed that 3 consecutive negative returns for S&P were there. Now, out of these 112, when S&P showed negative returns for 3 periods, 86 times the volatility index showed positive returns, which gives us a 77% hit ratio on this idea that most of the time when S&P shows a consistent decline, we see the volatility index has shown positive strength. This is very important, guys, because it improves and it shows the correlation between the volatility index and the S&P 500. It is more than 80-85%. And that is the reason why a lot of investors, they prefer buying a volatility index during the uncertainty of the market. Even if you buy on stocks, this could be one of the ideas how you can protect from the falling market, right? Will of course, definitely we will see the live prices of how this has performed. So very quickly, let me show you how this has. I'm going to my platform right here. So let's see. This is the index I'm talking about, right? Let's see, for example. Just look at this. This is today's 30th May. And look at this from 24th May, from 11.19, it has gone 11.30. It has gone all the way to 11.94, almost to 12. And look at this gap at which it has gone up, right? Let me maximize this as much as I can and go back actually more short term. See, look at this rise, right? Look at this increase in the last few days, which has happened here, right? Now, if you see and compare this, what has happened with S&P 500 in last few days, similar 30 minutes observation. Look at the trend. It's completely downside here, right? Look at this. This has come down right here. So while this S&P continues to go down, the volatility index continues to go up. That is the reason, one of the reasons that when we are talking about these kind of products, we are doing the observation and we are telling that this is something which can also be tried. So let's say as a traditional investor, you are invested into your stocks, your bonds, your fixed deposits, your real estate, your day trades, your long-term investments. A part of that could be, say, 5%, 10%, something can be invested into things like this. And especially during the time when there is a lot of uncertainty and unawareness of what is going to happen in the future about interest rates. We are looking at war situations, we are looking at US elections coming in. We are looking at US not cutting the rates at the moment, while Europe talking about rate cuts. So VIX is one of that. Another strategy which I can real quickly discuss is about Eurobuxel. Now this is European. Talking about a basket of German bonds, long-term German bonds, right? And going to show you a very neat flyer, a very neat flyer which can give you a very good information about. Let me quickly show it to you. Here. Now, as I said, this is a basket which contains European bonds, German bonds to be specific, right? All these German bonds which are higher maturity bonds. Now, the play is that, and to make it very simple for you, we observed and we established in our previous slides that how cut in interest rates of a economy by central bank increases the prices of bonds, because the bond which you are holding is giving you an X amount of coupon, while in the market if there is a rate cut, it will increase the value of your bond which you are holding because you are getting a higher return on that bond. Similarly, this particular strategy is about the expected rate cut which is going to happen in Europe, as European Central Bank has pointed out on countless occasions. Now, if you see the current chart of Eurobuxel, let me just point this out to you. Look at this right here. It used to be 220 euros, and this was back in 2021 when interest rates were cut down. And then when inflation came up and interest rates started going up, look what happened to the price of bond. From 220, it came down all the way to 120, and that was last October 2023. And now it is around 127 and 128. So this is at a decade low, if I must tell you. In last 10 years, again, this is one of the lowest which the German bonds have seen. And now, when finally European Central Bank is talking about cutting the interest rates, the lot of investors are basically trying to just buy this basket and hold on to it, and as the price goes up, you get out of it and you sell it. So this is basically to get a capital gain out of a bond. Bonds are basically known as to be fixed income instruments, right? But under this extreme situation, you're not trading into a German bond directly, you are buying a basket of German bonds, right? The prices of which are expected to go up if a rate cut happens. Again, as I said, that no investment comes with zero risk. This also has a risk. If rate cut doesn't happen, the price of this basket might go down further. But look at the price chart yourself. We are looking at a decade low of this, and this is something which is extraordinary. It doesn't happen every day. Again, a piece of information which you can always choose to get it reviewed by different analysts, different consultants, and this is just for your information that this is one area also for investment which a lot of investors, they sometimes, if they don't know about it, they don't check it, and that is the whole reason why we are conducting this session. Before we end this, real quick, there are some market neutral strategies, which means there are some strategies which you can do to reduce the impact of volatility on your portfolio. And some of them are called pair trades. And these pair trades are very, very exclusive. A lot of times we do a lot of back testing on these ideas. And for that, you need to understand how short selling works. And basically, when I talk about a pair trade, I give you two instruments. One, you have to buy because you're expecting the prices to go up. Other, you have to sell, you're expecting the prices to come down. Now, these pairs, they are a lot of research is done, and then these pairs are identified. Very quickly, before I end this session, I'll just share a very quick and market neutral strategy with you, and that is going to show you a very different idea of how you can invest. Real quick, if you see, look at this. This is something what we call as Norway versus Germany mid-cap index. The idea is very simple. Norway has handled inflation really well. The oil prices have gone up, which has put Norway in a very steady position. Their economic benefits are higher. They are a powerful energy exporter, and the higher oil prices have actually pushed Norway economy even better. The stock market index has a lot of energy based companies, so the Norway index is expected to rise, right? They're also getting benefited from the recent sanctions which have been imposed on Russian metals by US and UK. That has increased the prices of nickel, copper, aluminium, and that has also impacted Russian aluminium company, which is Rusal, right? And there are a lot of buyers who will look for alternative suppliers, and the best supplier for aluminium is again N- Norsk Hydro, which is a Norwegian company, and it is there in the Norway index as well. So their GDP is expected to slightly rise. They have faced inflation better. Their unemployment rate is slightly high, but much better than their peer, European peer, which is Germany, right? Germany, on the other hand, is not doing well. Their economy prediction is expected even less as the year progresses. It has been impacted a lot by the macroeconomic headwinds. So currently, the electricity prices in Germany are very high. So that is creating a lot of impact on the automotive industry as well. Industrial growth has been shrinking in Germany. So the idea is very simple. Expected If Norway is expected to do well, you put equal money in buying Norway and short selling German, right? This can be done through online platforms using derivatives. Leverage can also be taken, but high leverage can lead to higher gains or higher losses also. So you need to understand how to do this. Again, guys, the session was conducted to inform you about the alternative areas of investment, right? I'm sure a lot of you already do these basic vanilla investments, your stocks, your bonds, your real estates, and you do that already. And that's absolutely fine. I'm sure a lot of you must be doing day trades, buying, short selling. Absolutely good. This is something more. This is something additional. While we do the traditional form of investments, we definitely can always suggest you a lot of portfolios where you can buy stocks and do that. This is for those people who are seeking growth in their portfolio. Of course, all of these strategies, they carry a risk as well. So to understand more about this, we can definitely we are based in Imar Square. Anytime you wish to come and understand more about this, these are so easy to execute. You can do this on your online platforms as well, right? So as I said, anytime you want to talk about it, discuss it further, we are based out in Imar Square. I'm available on Microsoft Team or Zoom if you want to conduct a session or basically discuss about this, and we'll be more than happy to discuss it with you. Few questions I would like to answer over here since they have been asked. Is there a similar demo account which we can get? Definitely. If you have been enrolled through a relationship manager and if they are in touch with you, you can ask them for a demo account and we'll definitely be able to provide you. Another question over here is about, can we get a copy of these strategies? Definitely. As I said, you can talk to your relationship managers and they can send you these PDFs. You can read them out. And if you don't understand them, please definitely come to us and we'll definitely explain you every single bit what is mentioned over here, right? Uh, when are you available? I'm definitely available for a session. Just give your RM a heads up, and I can schedule a specific time up to your convenience. We are working 11 a.m., basically 10:30 to 11 a.m. since when Europe opens, and we work till 8:30 to 9. Consultants they sit even more till 10:30. So depending on your convenience, we can definitely conduct sessions. So no problem about that. And okay, how do we contact you for further? Just if there's a person who's already in touch with you, you can definitely reach them out. I'm sure somebody must have uh, given you a call from the company, so you can just tell them to have and finalize the session with Yogesh, and I'll definitely be available. Just in case, I think a lot of you are asking for the email, so I'll just put it right here. You can reach me out through email as well. Let me send it out to all. It's basically Yogesh at century.ae. And I'm just sending this to everyone here. I think everybody should get it. Yogesh at century.ae. This is my email, and you can definitely reach me out personally as well. And we'll definitely have a session for this. So, once again, guys, if you like this session, we continue to do this more. And please review us on Google and Century Financial in Google reviews. My name is Yogesh. And if you like the session, if you like to have any feedback, it really helps us to improve and motivate us to do more and more of these sessions. So please do review us on Google, and please write about us, and we'll definitely be in touch with you. Next week we'll be back with another topic, another interesting strategy. Until then, what we have discussed today, if any one of you want to discuss it further, please reach me out and we'll have our own one-on-one session. So all of you have a great night. Thank you so much for being a part of this wonderful session. My name is Yogesh. Have a good night.